Welcome to another episode of Equity Mates, a podcast where we explore what's possible in the world of investing. If you've just joined us for the first time, a massive welcome to the community. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you going?
I'm very good, Bryce. Very excited for this episode. There's been a number of YouTube comments about me saying I'm excited, but how could you not be excited? There is so much happening in markets. It's hard to keep up with. If you're not investing, I mean, you're missing out.
Yeah.
To put it bluntly, why would you not be investing when so much is happening in the US, back here in Australia, in crypto markets? It's all happening. We're going to break down a lot of it in today's episode. We're also going to speak to Charlie Viola, the founder of Viola Private Wealth. He's going to give you a sanity check. About time, I say. And we're going to talk about why we love investing. I mean, that's this whole podcast. But we're going to talk about why the share market has been history's greatest wealth creator.
Yeah.
But before all that, Bryce, let's get into the news of the day.
News and markets.
Well, Ren, I want to kick off with the biggest news of the day, which...
Bitcoin's hit 100,000?
No, bigger than that.
Not quite. I've been watching it. It's almost there. It keeps touching the side of it.
It's consolidating, isn't it?
Yeah.
It's going to go nuts once it hits it. No, the biggest news of the day, Ren, is that we found out that we've won the Australian Business Book Awards Best Personal Finance and Investment Book for 2024.
Yeah, didn't even know we'd been nominated.
Didn't even know we'd been nominated.
Thank you to the awards committee.
Didn't know it was happening, but pat on the back to us.
Yes. Bit of a stretch, you squeezing that into the news segment.
But if you're looking for a Secret Santa present or to give the gift of compound interest and building wealth over the long term, then don't stress. Just Invest is the book for you. We'll put a link in the show notes.
The only gift with a guaranteed return on investment.
Yeah. Well, yes.
All right, let's get into the news.
Yes, let's get into the news. So we'll start with Nvidia. They reported a couple of weeks ago, which we covered. So you think that life couldn't get much better for Nvidia, but it does. It does.
Even after reporting, more recent news has shown that things are somehow getting better.
Yeah, their latest generation Blackwell AI chip is now sold out until the end of 2026. This is their next gen chip that billionaires are squabbling over. And it really does put perspective to the 25% sell-off that we saw in late July, early August over concerns of the Blackwell chip.
What a buying opportunity in hindsight.
I know.
It is a reminder, that 25% sell-off, that even the best performing stocks don't go in a straight line upwards. They have drawdowns, they have sell-offs, they have moments of panic. And if you are buying individual stocks, that's your opportunity. Unfortunately, neither of us bought Nvidia at that time.
No. Do own it in the index, though, which has been driving a lot of our returns.
And also in some actively managed funds that I have. I think you have as well.
Yeah. No, I don't have.
Okay.
Yeah.
So, look, we say things can't be getting better for Nvidia, but there has been a little red flag that's emerging, and it's a good investing lesson generally for us to learn about for whatever stocks we're investing in. The risk is customer consolidation risk. Now, if your revenue is rising, but you're only selling to a few people, that creates a risk if some of those people stop buying.
Yeah.
And how are these numbers from Nvidia's latest 10Q that came with their quarterly earnings? So in Q3, the most recent quarter, 36% of Nvidia's $35 billion of revenue came from just 3 customers.
Wow.
3 customers. In those 3 months, each of those 3 customers were responsible for 12% of Nvidia's revenue each.
Jeez.
So there's a bit of a consolidation risk there. Now, this isn't a new phenomenon. If you look back at their Q2 10Q, say that fast 5 times, there were 4 customers that made up 46% of their quarterly revenue. So there's just these few customers that are making up a bulk of their revenue. Now, they haven't disclosed who those customers are, but I think we can guess pretty easily who they are.
Yes.
So one article we read said Google, Google's parent Alphabet, Meta, Microsoft, and Tesla, they reckon are the 4. I would hazard a guess maybe Oracle or Amazon could be in that list. But it's really, we're looking at the big hyperscalers, the big data center players that are building the compute power that then OpenAI, XAI, Anthropic, all these AI models use.
Yeah.
Yeah.
Nvidia for me is a watch for 2025. I think I've said it. Nothing we can do about it, but I feel like one day we're going to wake up and they will have reported overnight that one of those 3 or 4 customers has come out and said we don't no longer need to make these levels of investment because we're just going to now let this play out.
Yeah.
Which is then going to lead to revenue forecasts changing for Nvidia.
Yeah.
And then I think the market is going to respond to that accordingly, and it's one of the largest companies in the world. So it is a major risk, unfortunately. Like, there's nothing we can do about it.
Yeah, so I think there's 2 sides to this equation. The negative slant on this news is, you're right. If any of these big customers stop buying Nvidia chips, that will really change things for Nvidia. They'll miss forecasts, that the hype will start to come out. It could be that Microsoft decide they're not getting enough ROI on the investment, return on the investment, so then they stop buying. Or it could be that some of these companies are trying to develop their own chips and they might have a breakthrough and they need to stop buying Nvidia chips. That feels highly unlikely, but it is could happen.
Possibility.
So that's the negative slant on it. The positive slant on it, if you're still bullish on Nvidia and you don't think this is a risk, is look, they're selling to these companies because of course these companies are first in line. But if these companies weren't buying Nvidia chips, there's a long line out the door of people that would replace these big buyers. And so the chunky nature of their customer cohort is just because these are the trillion-dollar giants who have the deep pockets and who are first in line to buy the new technology.
Yeah.
But it's actually there's not a risk because there are smaller players who would buy.
Yeah.
Which is right and which is wrong and which will continue to be right is the questions that you need to ask if you're a Nvidia shareholder.
Moving to our next headline that caught our attention. The latest data from APRA has found that 35,000 Australian households are behind on their mortgages, which represents about $23 billion in loans.
Now, to put that in context, the APRA chairman, John Lonsdale, said that this level of mortgage stress is double the proportion we saw in 2016. Why he's comparing it to 2016, not 100% sure. But this is the news that kind of confirms what we're all seeing and feeling anecdotally. It's that like a lot of Australians are really struggling with their mortgages. $23 billion in loans divided by 35,000 households means the average loan size in that cohort is about $650,000. Yeah.
I think a lot of property bulls would argue it's a small proportion of the total, loan book in Australia at the moment.
We found these numbers from CoreLogic. They're a little bit dated. They're from the back end of 2023. Australia's mortgage debt, $2.2 trillion. Crazy that it's 2.2 trillion. Also, the total value of Australian housing, 10.1 trillion, according to these numbers. But if those numbers are right, 2.2 trillion in mortgage debt, 23 billion of it under stress. That's about 1%.
Yeah.
So it is small in the context of things. That's cold comfort to the 35,000 Australian households that are feeling the pinch. And I think it's worth keeping that in mind because we're seeing some signs that a lot of Australians that are feeling the pinch are selling.
So clearance rates, auction clearance rates is a good measure of buyer sentiment, and they're at an all-time low in some of the major cities. Or seller sentiment, whatever.
No, or buyer sentiment.
Yes.
But we're actually talking about seller sentiment here.
Same thing.
Here's an indicator of seller sentiment. CoreLogic track total sales volumes. This is as of October 2024. Over the past 12 months, sales volumes are up 9.2% nationally.
I also use the headlines in the Sydney Morning Herald as a guide to what's happening.
Sentiment indicator.
And I reckon in the last 14 days, 2 weeks, there has been a headline on these suburbs, prices falling. Where can you buy now in suburbs that are expected to be down 5% in next 12 months? So like that rhetoric is now coming through in the papers as well. Prices down, houses out. So it's going to be an interesting year, 2025.
Yeah. Well, and it seems like if we see Trump's economic policy flow through, the conversation is that there will be inflationary, not just in the US, but likely around the world. So people expect rates to be higher for longer is kind of the narrative that we're seeing, which means that mortgage rates will be higher for longer as well. So this is a story that is playing out and likely will continue to play out. So this is going to be one that we want to watch in 2025.
So Ren, at the top of the show, you said I needed a sanity check. That is true. I'm going to give Charlie Viola a call to talk through some of the core positions in my portfolio because they've done very well and I'm wanting to know what to do next. Let's give him a buzz.
Bryce, how are you, mate?
Good, Charlie. How are you?
Yeah, very good. Very
That's
good.
I've got Ren here as well.
Hey, Charlie.
How things, boys? Good?
Yeah, good. Bull markets are always fun, so...
Yeah.
Now, for people who are new to the podcast, Charlie is the founder and managing partner at Viola Private Wealth and is our go-to when it comes to questions of, in managing our money, portfolio construction, and...
A sanity check.
Sanity check, as Bryce has called it. Bryce has got had a question about his portfolio, and we're lucky enough to be able to call you, Charlie, and ask you.
Yes.
Or it's an insanity check, one of the two.
Well, we'll find out. So Charlie, here's the situation. I run a core portfolio of 4 ETFs, which I revealed on the show a number of months ago. 2 of the core positions are leveraged ETFs. One gives a leveraged exposure to the S&P 500. One gives leveraged exposure to the ASX 200, both to about 2 to 2.5 times. The other 2 positions are index funds that give exposure to Europe and to Asia. Now, I've tried running them as close to equal weight as possible. I think the biggest spread they've ever been is sort of the lowest 12%, highest 18%. But now, given the performance of particularly the US over the last 12 months, this US fund has run almost 100% in the last 12 months. And so the weighting now is completely out of whack. And I'm in a position of tossing up the whole, it's a core portfolio, let it run, a time horizon of 40 years, it is what it is, or portfolio construction, should I be trying to rebalance effectively and taking some of that profit from the US and Australia and redistributing it into my other core positions. Now, I know you don't know anything about my financial circumstances, so this would be a question on how you would advise your clients to do it. And for everyone listening, actually, we should note we're recording on the 26th of November. What are your thoughts?
Yeah, so firstly, probably well done. In terms of the outcomes that you've seen there. And good to know that you get on this show and you talk about this stuff and you're unequivocal because you do it with your own money. So, look, I think there's a couple of pieces to this. One, we're probably still reasonably bullish, especially US markets, given Trump and him being very pro-business and what's going on there. But for us, and the way we talk about it and the way we think about it all the time, is diversity is important. Portfolio construction and asset allocation is actually really important. So, I think the reality is that given the uplift in the value of those 2 geared positions, we'd certainly be telling clients to start thinking about taking some value. Like, nobody ever went broke taking winnings, right? So we think that, paring back some of your risk, because when you began this portfolio 12 months ago or 18 months ago, you had a certain level of risk that you were taking. That risk has now gone up quite significantly, and you've been rewarded for that risk, clearly, because obviously, the asset values have gone up 100% and 80% or whatever they've gone up. So you've been rewarded for it. But now, as a result, if you just look at your expected return on invested capital and the risk that you're taking now, that risk has actually gone up quite significantly. So whether you just rebalance into those 4 or you turn your core into something more like 6 stocks and you move a portion of the winnings from those 2 geared into ungeared arrangements, just so that you're not so susceptible to the downside if we do see some downside movement, or we see sentiment change, or or, Trump comes out and does something silly and we see markets get sold off for a period of time, just so that not so much of your capital is so susceptible to market movements, it may make sense just to unlever a portion of them, take a bit of winnings and unlever a portion of them, if you still have the view that, global equities will continue to do really well, and etc. I think the key thing here is you're now taking way more risk than what you were when you started, and that's fine. But it's probably time to rebalance it, bank a bit of the winnings, and then sort of almost kind of reset the way that you're thinking about the portfolio as a means of what the next sort of 4 or 5 years, because the risk profile of that capital has now changed because you've got so much more sitting in, one of the buckets as opposed to kind of all of the buckets, if that makes sense.
That makes sense, yeah. I think you're right, because those two ETFs now make up about 45% of the portfolio. I think at its peak 12 months ago it was closer to 22 or 30%. So, it's now, half the portfolio in those two markets. The internal battle I have is just like...
watching the winners run.
Yeah.
It's like that. Remember that. So watching the winners run is always really nice until it's not. But if you just kind of take a step back and kind of become a little bit unemotional about it and kind of become mathematical about it, you've now taking twice the risk. You've got twice as much money in the same asset, and they're the levered positions. So you're also taking twice the risk. So really, you 4x your risk on those positions. So, and it's fine to still have a view on those markets that are running. It's still fine to have a view that, US equities and big tech and whatever else will continue to run. Just unlever them so that you're not so susceptible to downside when, if and when those markets sell off at any given point. And I absolutely get that in 12 months' time, if it continues to do what it's doing, you'll look back and kind of go, that's really sad. I, should have left it where it was. The point is that will you be rewarded for the risk that you're taking, because you're now taking heaps of risk.
Yeah. Nice.
So Charlie, from a practical perspective, there's sort of a couple of ways Bryce can rebalance. He can sell some of his winnings in the geared stuff, especially the geared US stuff, and reallocate it into some of these other funds. Or he can just take his regular dollar cost averaging every fortnight that he gets paid and stop allocating that to the US geared stuff and put it into his other funds, and so rebalance, I guess, over time. Do you have thoughts on either of those strategies?
Yeah, it depends on how big his dollar cost averaging is. So I don't know how well Equity Mates is doing and how much you guys are paying yourself to be able to stick in thousands and thousands of dollars a month. To it may not make too much change by just doing the dollar cost averaging.
It'll
so
take
it may
a while
well
to catch
be.
up.
Yeah. It may well be actually a matter of doing a little bit of both, because. And again, this isn't advice, but you need to be obviously mindful. You may well cop a little bit of capital gains tax in terms
definitely.
That's the other thing.
sort of taking a little bit of the winnings. Normal portfolio construction would say that if you had a certain objective at the beginning and a certain risk profile and a certain kind of view in terms of how you allocate your capital, your capital is now allocated very differently, right? So your tracking error on that portfolio and your risk return trade-off is very different to what it was previously. So, it may make sense just to bash it back into shape, wear a little bit of the tax. It means that you've done well, and then allocate to those other parts so it does catch up. But yeah, I'd be slicing a little bit off the top and pat yourself on the back. I'd take the wife out for dinner, and then
None of that.
I'd reallocate to the other ones, or at least if you're still retaining a view to some unlevered positions, because right now you're so susceptible to the market movements.
Yes. Charlie, that's very sensible advice and we appreciate it. The final question is actually for Bryce here. Now that you've got that sensible general advice, what are you going to do with it?
I honestly have been thinking it's been weighing on my mind the last month or so what to do, and I had come to the conclusion I should just rebalance a bit, but the tax piece kind of gets me a bit, and the long-term nature of my investing. It's like, does this really matter over 20 or 30 years? But I think maintaining a discipline around the construction of my portfolio is something that I kind of want to do. So I think having Charlie say that will lead to me rebalancing?
The allocations themselves aren't particularly the issue. I think it's the leverage portion. So there's probably there's probably nothing wrong with, continuing to allocate to those parts of the market if you have this really long-term and long-held view that it's going to do really well. The issue is the leverage, because the downside will really hurt and it will eat into, it'll have the same impact on the downside, right? Which means the ability to claw that back makes it much harder, and markets have to work much harder to be able to get it. So it's just take some winnings, unlever it, and then continue to allocate to the bits you really like.
Yeah, that's a good shout. Sack the leverage. No, but they're so nice. I get what you're saying though. I was looking at we about 3 or 4 years ago looked at this on the show, and it took 2 or 3 years for the geared ASX 200 to recover versus the ASX 200 post-COVID, because the drop was so significant and so sharp that it had to play so much catch-up that it took 2 or 3 years. So that's what I've had that experience. I was fully invested in the leverage product at that point in time. So I'm now thinking, how do I, without selling the whole position entirely, just restructure this a bit so it's a bit safer.
So basically your conclusion
you've just made your point.
Yeah. Basically your conclusion is the groundbreaking concept that leverage works well on the way up, but not on the way down.
Yeah, well, we all know that. It's working at the moment.
Well, Charlie,
Nice, Charlie.
we appreciate the sanity check. I'm sure it won't be the last time we call you for a sanity check, but we appreciate it.
Yes, as always.
Yeah.
I will be interested to see whether he actually does it. Then, like I say, it will be the insanity check at the other end.
Yeah,
So.
now it comes down to behavioral psychology. So anyway, we'll leave it there, Charlie. I'll let you know how I progress, but thank you for the general advice. Much appreciated.
Cool. Thanks, gents.
As you know, we love investing. We love stocks. So we're going to finish on a bit of a high note here, Ren, and talk about why the stock market has been the greatest wealth creator in history.
Yeah, well, I think you only need to look at this episode so far. You've spoken to Charlie about your 100% return in the past 12 months in a levered index product. We started the episode today talking about Nvidia and what it's done. So that's the segment.
That's what more do you need?
I think what we want to do here is zoom out and not just talk about the stock market of the moment, but historically, it has been just such an amazing wealth creator. Hendrik Bessembinder has been, he's done a lot of research both in the US and more recently on global stock markets and just about how much wealth has been created.
Who's Hendrik Bessembinder?
He's a finance professor at Arizona State University.
Okay, nice.
You don't know Hendrik?
No.
Well, you will after this. So between 1990 and 2020, so in 30 years, in the global stock market, $76 trillion of wealth was created.
76 trillion.
76 trillion.
Wow.
And I think that there's a number of different ways that you can unpack how it's been the greatest wealth creator. And I think you can start by looking at the world's richest people. They come from different geographies. They come from different businesses. They come from different, worldviews and upbringings. But what is the one thing that they all have in common?
They own part or all of a business.
Yes.
Equity.
They own equity.
Yes. Equity that is, well, I don't know if they all own equity that is listed, but it's owning a business.
Yeah.
Which you can do through the stock market.
Yes, yeah. Or their parents did. But that's
lucky, yeah.
If we look at the wealthiest people who are obviously generating the most wealth, it has been from owning shares in companies.
Yeah.
And generally starting those companies as well.
Yeah.
But it's not just the ultra wealthy that have benefited from the stock market. Everyday people have enjoyed the wealth creating effects of the stock market. In 2022, Gallup found that 58% of Americans had invested in the stock market. But in Australia, that number's even higher because of compulsory superannuation. The bulk of superannuation is invested in the stock market, and the bulk of their returns come from the stock market. And we all benefit from that. And the size of Australia's superannuation industry is just wild now. Like $4 trillion or something like that. It has been such a good wealth creator that successive governments around the world have pinned their country's retirement hopes on the stock market.
Yeah, good point.
Yeah.
Yeah. Not the crypto market, not the property market. Well, they don't need to in the property market here in Australia, but
Yeah, crypto market didn't exist when Keating introduced superannuation. But I think it is just like, we should recognize that like government policy has
recognize the long term.
recognize the wealth creating power of the stock market. It is it has been profound just how much wealth has been created, and it's something that you haven't wanted to miss.
Yeah.
But it hasn't been all stocks, and that's where Hendrik Bessenbinder's work becomes really interesting. Because as I said, he looked at both the US and he looked at global stocks, and he looked at where that wealth creation is coming from. In the US, he found that 86 of the top performing stocks, which is less than 1/3 of 1%, so 0.33% of stocks, collectively accounted for more than half of the wealth creation.
It's crazy.
And we can think about what those stocks are recently, Apple, Microsoft, Meta, Amazon, those outsized returns. But in a generation before, it would have been, Boeing and Walmart and some of those big companies today that just had unbelievable growth on the stock market. But you can take it a step further and you can say it was just 1,000 top performing stocks, less than 4% of the total, that accounted for all of the wealth creation.
Wow.
If you just had invested in the 96% remaining stocks, like not that 4%, the remaining 96% of stocks, you would have just matched the return of 1 month treasury bills.
Wow.
So all of the outperformance in the US came, and I think he in this study, he looks from like the 1920s to today, came from 4% of stocks.
Gosh.
Now that finding holds when he zooms out and looks globally as well. He found that the best performing 1,526 global firms, which was 2.4% of the total, accounted for 75.7 trillion in global stock market wealth creation between 1990 and 2020. So we started this segment by saying 76 trillion. It's all been driven by this 2.4% of stocks. But you can zoom in, just of that time, 1990 to 2020, just 5 companies globally accounted for 10% of global wealth creation. That's 0.008% of companies. Now, what are those 5 companies?
The classics. Apple.
Yeah.
Microsoft. Amazon.
Yeah.
Alphabet.
Yeah.
The other one I would have put down as... Well, since 1990 to 2000, probably would have put in there like a Tesla or someone, but it's Tencent.
It's Tencent. Yeah. The Chinese internet giant.
Yeah.
So those...
And you look at the Forbes list of richest people in the world, and they're all the founders of those companies.
Yeah. So those 5 firms accounted for 10% of global wealth creation. The best 159 firms, 0.25% of the total, accounted for half of global wealth creation. And then the best 1,526 firms, 2.4% of the total, accounted for all of the global wealth creation on the stock market in that time.
Yeah.
So to answer the question why the stock market has been history's greatest wealth creator, it's because these few generational companies that generate the wealth are listed on the stock market and are accessible for all.
Yeah, that's the point.
And that is what you want to invest in. And you can think back generation to generation, technology to technology, and that story plays out. If you think about, the motor car, it was Ford, the Ford company that was listed. If you think about like household appliances and that boom in the 1950s, it was companies like Westinghouse. Then if you think about, the large format retail boom, I said Walmart, those are the companies. Then you've got your Boeings, then you've got your GEs, and now more recently you've got your big techs. Like, it is the same story that plays out over and over again. Those high quality, once in a generational companies that drive the stock market and drive the wealth creation. And so our job as investors is just not to miss those companies.
Easier said than done. No, it's actually not. And so there's 3 ways in which you can not miss out. The first is to try and find the companies yourself, which obviously comes with a bit of work and time involved in doing that. And you need to manage your own portfolio. The second is to have to find an active manager to do it on your behalf. We know the stats around the troubles that active managers have in consistently beating the market, or at least consistently matching the market. A lot of them can't do that.
Yeah. And this makes sense why. Like, if you need to nail the stock picks, the 4% of stocks or the 1% of stocks, it's hard to do.
It is very hard to do.
And we recently spoke about Cathie Wood, who was right about Nvidia, but sold at the wrong time and left $1 billion on the table.
Exactly.
That is a classic case study on the perils of active management.
Exactly. And then finally is to invest in the index. We've spoken about this time and time again, and there is a reason for it, and that is because index ETFs are designed for you not to miss out. The structure of them allows for the good companies, those that are driving the returns, to come through to the top. You never have to pick a stock yourself. You never have to worry about buying or selling any individual stock. Let the index do it itself.
Yeah.
So that is why we are the index boys.
That is why a lot of segments on this show end in that concluding thought. But there is a reason for it. The research backs it up. With the index, you don't miss out on those few stocks that have driven the stock market to be history's greatest wealth creator.
Yeah. And we have the same opportunity as the Forbes 100 richest people in the world, which is to literally own the same companies that they do.
Yeah. All right, Bryce. Well, that does it for this episode. If you want more on investing, pick up our book, Don't Stress, Just Invest, winner of the 2024 Business Book of the Year, Personal Finance and Investing category. But we'll be back tomorrow with an interview with JP Morgan Asset Management's Kerry Craig. And then we'll be back next week. It'll actually be our final week of the year. I'm off to get married, so we'll be off and we'll have a summer series playing over summer with interviews with some of our favorite investors. But we'll be back tomorrow, next week, the week after. The content train never stops.
No.
But I'll duck off and get married.
Nice.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.